Hi, everyone. So we'll try to make this as hopefully interesting and insightful as possible. So I'm very, very honored to be on the stage with some very, very good investors. And by the way, congratulations, Lars, on closing the very, very large fund.
Thank you.
And so let's kick it off. This is probably, I promise this is going to be the worst question, but this is to set context. How do you guys see the fundraising environment for startups in early stage, seed, Series A? Just to give context as well, too, I'm coming from a very U.S. context, so I run an accelerator program that's somewhat known, and so we've definitely seen a big change in the early stage investment side, where it went from incredibly stupidly bubbishly, sort of like where almost anybody was getting funded, to a huge change where it is very, very challenging to raise seed, and a lot of the third-party data has proved this. What are you all seeing with this?
I mean, maybe I'll kick off because we see the earliest of early stage. I'll paint a very optimistic picture. Actually, I think whereas I am hearing out in the U.S., it's people are pulling back and quite conservative. I think on a relative basis, it's much easier to raise early stage funding in Europe than ever before. And I would say compared to the US, it's actually much easier to raise money at the very, very early stage. So a lot of different policies and a lot of different things have come into effect in the last 5 years or so. And I think if you're raising up to €1 million, euros, dollars, pounds, maybe even, you can just almost fall out of bed and raise that kind of money. So there is an incredible amount of activity and optimism in the early stage. Now, where it starts to get later, I'll let these guys comment, but it definitely narrows down a lot.
Okay. Martin?
Yeah, I think, is that working?
No,
it's not.
Okay, that's good.
Yeah. I think I totally agree with what Reshma is saying, and we see a big difference with the US right now. I think Europe has. I've been doing this job for almost 7 years now, and we've seen both the number of companies and the intensity of the competition increase massively during the past couple of years. So you both have kind of local funds. Each country has their own kind of local guys doing seed and Series A, and also now more and more so kind of pan-European investors doing from C to A and B. So equity. Just raise a fund. Congrats, guys. We raised a fund earlier this year, early stage fund. Axel raised an early stage fund. So you get a lot of money, and we see the deals really happening much faster. I think the slowdown really happens after Series B, and maybe a bit less so in Europe. But yeah, in the US we are seeing some of our later stage companies raising large rounds. We definitely see a big shift in sentiment, and people in the US being very much in waiting mode as soon as we are talking about kind of 20, 30 million plus type of round.
Yeah, sure. Lars, how about you?
Well, as a new kids on the block, it's a bit difficult to compare with how it's been in the past, but I think we're seeing quite a healthy deal flow. Deals are being made. I think valuation-wise, Europe was probably already before the more healthier levels. There's probably less of an adjustment than some of the early stage deals in the US.
Yeah, so I've been investing now for probably about 2.5 years, and there was definitely a big change where when I was first starting, the range of valuations, granted this is Silicon Valley valuations, were like 3 to like 6 mil caps valuations, and then over like a 1.5 year period from like 2015 onwards, just to give context, we saw it go from like 5 to like 8. And so in a very, very short period of time, mainly because of pure supply and demand, lots of money and not a lot of, well, still a lot of startups, but a lot more money coming in. And so, in light of that, like what industries and what, let's put that question aside, but, what investments have you done recently? And I'm curious of like why, like are there specific sectors or things that you were looking for like in the last sort of 3 to 6 months?
Yeah, so I think we've been pretty quiet so far this year in Europe, and one of the reasons being that there is a lot more competition, and so valuation are getting a little bit out of hand, and also kind of the deal velocity is much faster. So we've been a little bit quiet. I think some of the later things we've done. We put a small. We just announced this week a small seed round in a company called Menu Next Door, which is kind of a peer-to-peer marketplace for cooking. A lot of people have tried. We think these guys have already built something quite interesting in Brussels, Paris, and London. So again, large sectors we know well. Pretty a model we are quite familiar with. Another notable one, another seed investment late last year, a company called Revolut, which is a kind of a mobile payments system. Again, there are quite a few of those around. One with Seedcamp involved as well. And but again, mobile first, with building their own stack in to make FX payments much more seamless, and both kind of mobile and with a card. So very very interesting. I think those are kind of some of the spaces we look at. So food, fintech, some health tech stuff we're looking at as well. I think those are the main things. If you think about like more the long term, the disruption started with digital first market, and now we're moving more toward the edge of the disruption. So regulated sectors, physical sectors, food, and health tech. So those are kind of the main areas.
I think also you have to contextualize. So I think again, we're at the very bleeding edge, and we have to make some pretty kind of risky bets, right? So I think what we're looking at is often a year or two before what the later stage investors would look at. So some of the sectors, health tech is definitely getting more and more interesting. We backed a company called Thriva recently. They allow you to do much more sort of around blood testing at home, and then it gets shipped out to proper doctors who do the testing. So it's it's an interesting kind of dual step process versus maybe like a Theranos. Right. So again, in health tech, we've made a number of those investments. Absolutely in food tech as well. FinTech, we've been the most active investor all across Europe. Recently, we backed a company called Finance Fox that's been growing, incredibly well, especially in the DACH region, and then going beyond that. So insurance is very interesting to see how that continues to develop. We invested in a company called Wings, which might be sort of counterintuitive, but it's the first mile of package pickup, I guess. So in that whole kind of delivery space, we've gone at the other end of it, which is maybe a bit interesting, counterintuitive. So, and then prop tech, again, we've been the most active investor in the UK. About 10% of our portfolio is fintech, 10% is property tech, so real estate tech. In there, kind of everything. One of the companies is Property Partner, which is a very complex end-to-end business around investing for buy-to-let. So prop tech, fintech, health tech, things around sort of food, and then on the bleeding edge, AI, VR. We have a company called Splash VR we recently did with Greycroft, and then in the AI space, we're looking at a bunch of things. The one thing I will say is, I think in the early stage, the job has gotten very difficult because as an investor, because you're having startups start at exactly the same time in sort of San Francisco, New York, London, and then maybe Berlin or Paris or Stockholm, and they're doing the exact same thing. So I think the job in a way at A or B is a lot easier because you will know who the winners are by that point. And at the sort of seed or pre-seed, it's very difficult because the valuations are high. You're having to invest because that's you see the future to be there. So I think we're being very careful about who we get around the table as co-investors in those rounds, and making sure there's enough geographical diversity to really kind of pick the winners that we hope these guys will go on and invest into.
But similar to Index, EQT Ventures is a generalist fund looking at all sectors, but primarily on software companies with a very strong tech team. That's what really gets us excited. I think from a deal flow perspective, I think there are a lot of companies in fintech, as you mentioned, health tech. We did one called My Doctor in Sweden earlier this year. We think that if you look at the digital doctor space, one hypothesis would be that it will start in the Nordic countries. There are already government-sanctioned pilot rollouts where you get government subsidies for digital healthcare as well, not just for physical visits to doctors. And Min Doctor is in the middle of that space. We think healthcare obviously is going to be one of the sectors going to be transformed from a digital perspective in the next 5 to 10 years.
Yeah. I mean, and I think just putting this sort of also in perspective is, if you've sort of heard some general themes and trends, it's no surprise that you see fintech and digital health and other areas are big, massive spaces that are VC fundable, but also, frankly, are not particularly well run. And so this is actually where, this is why we're excited actually as investors. Software, unfortunately, eating people, right? But this is actually a real thing. It's happening. And this is what we do, is invest in sort of spaces that, frankly speaking, treat their customers like crap. And so that's actually where the opportunity is. For me, it's like a hate-driven thesis of if your customers hate the incumbents, it's a really, really interesting opportunity to sort of go after. And so what have you learned? It's become more competitive. You all said it. There's more and more investors now. It's harder to figure out sort of all the different signals of all the plethora of huge, interesting companies coming up. What have you learned over the last period of time, and what are you trying to do to sort of get better and become better investors? As a new investor myself, I would love to hear.
I think so. One of the things, because we, like you guys, we do a lot of sort of volume investing, right? And we invest in 30, 40 companies a year. I think one of the biggest lessons is you've got to be founder-led. And I think at the very early stage, when you're still really developing what your business is and what your vision is and what your product is, I think as investors, who are coming in at the kind of the ground level, it's tempting to jump in and want to design what that business is and have your own vision be, and put it into the business. And I think one of our biggest lessons is that never really works, and it's really, it is very founder and management team led, and you have to see that the vision comes from them, and that they're going to be able to have the longevity, the horsepower to really kind of take those products across and build that business. So that's definitely one of our biggest lessons coming in so early. And I would say the second one is, I think as you get from lessons from TransferWise and others, is you can't be a one country company, and you can't just be one market winner. Even if you're going to be a pretty dominant player, that's pretty hard to do. So I think that's the other challenge, is how do we push our companies as they get towards out from seed to Series A, B, and beyond, is how to really get them global and bring on the management team that will take them to that scale, because often the early team doesn't have that experience. So those have been two of our biggest lessons, and we continue to fall into some of those traps, but are challenging ourselves, not to.
For you, Martin.
Yeah, I think tons of learning over the years. I think as an investor, we don't do volume investing, so we are much more handcraft people. We work with a few companies per year, and so all the core of the job is identifying the signal in the noise. That's what it's about. So it's kind of ignoring everything and then focusing on the 2 to 3 to 4 companies a year that are really going to make a difference given the size of the fund. That's really, really hard to do. So you have to and that's why we pass on most opportunities. And so we constantly refine. We had an offsite actually earlier on Monday where we kind of looked at kind of an entire portfolio and of companies in Europe that we had missed and why did we miss them, and at what stage do we miss them, and what would we be doing differently. And I think that's the only way. You keep on iterating and on improving. So that's from our side. And the main learning is there's a core tenet to what we do, which is invest in companies that gets easier as they grow bigger. Which means you have to be in a large enough market that there's no ceiling. If you're in a too small market, you hit a ceiling and it gets really hard to grow. And also you need to have a model that has something inherent to that model that makes it easier to grow, because either it's a scale effect, or it's a data effect, or it's a network effect. And so the more people you add to the platform, the more valuable it becomes. So I think that's it. There's that for us, because we're looking for the $1 billion plus kind of outcomes. That's all that really matters. Large enough market with those kind of effects. I think that I would just go on the learnings on the entrepreneur side, and what we're seeing now. It's I've been doing these jobs, I said, for almost 7 years. And so far it's been, up and to the right, pretty much. More money, higher valuation, more startups, more everything. And it's for the first time. There was a little bump, 2 years ago in the market when there was a kind of first little correction. And then there's been, earlier, this January, there's been a big bump. When you get LinkedIn and the SaaS multiples, dividing by 2 over pretty much a day. That's a significant, that's pretty unusual, and that's a crash. Whatever you call it, it's a crash. So since then, it's recovered a bit, but there is still that very much, as we say, like kind of a wait and see mode. And so I would say, as an entrepreneur, now that I'm seeing that, raise as much money as you can. Don't wait and don't try to optimize on valuation and dilution and so on too early, because you never know what's going to happen. And even amazing companies with incredible performance, if people don't want to invest in, it's just like people stop wanting to take risks. And you never know when that's going to happen. And when that happens, you'll be very happy that you have enough money in the bank to maybe go another year without raising money if you don't have to. So that's the good learning from the past few months.
Well, similar to Reshma, we're definitely looking for founder-led companies, fairly broad teams of complementary people, similar to the way we set up EQT Ventures. The slogan we had yesterday was half VC, half startup. We built a team also a tech partner, analytics partner, design partner, more of the complementary skill set, and that's what we're looking for in opportunities that we look at as well. Teams that are dynamic and broad, in other words. In the long term, especially in the early stage, the team is what's going to be the difference maker in the long run. In terms of,
Well, this is a crowd of entrepreneurs, right? And so, we only have a little bit over 9 minutes left. Any general advice that you'd actually, if you're looking to pitch you, or what's the best way to get in touch with you? What are the things that you hate? No, it's actually a relevant question. What are the things that you hate when entrepreneurs basically approach you? What are the things that they should be thinking about when they actually want to get money from you? And what stage should they be at, roughly?
So we are generalists, so we can start at 500,000 euros kind of seed round all the way to kind of 50, 60, 70 million pre-IPO. And I think you just have to think, we try to put ourselves in your shoes when we deal with entrepreneurs, and I think you have to think the same way. And what I just said is all about signal versus noise. So if you're just sending a cold email, we receive hundreds of emails per day from various places. If you don't have context, if you don't have the right number we're looking for, then you're putting yourself at disadvantage. I think, obviously, all of the typical tips of kind of warm intros, are helpful. But I think the best way is basically not you coming to us, but the other way around. It's build something that's showing traction, that's being visible in the market, that's getting good customers, not necessarily many customers, but some very engaged customers very early on that are really passionate about your product, and we're gonna find you, because we have our entrepreneurs, we got our data science tools kind of tracking the market, and if you exhibit something that's pretty unique in terms of engagement and passion and traction, then we're gonna somehow we're gonna find you. So I think focus on building the core product and the core fan base, and we're gonna come to find you. And I think that's the best way to start the relationship.
So the net is basically just like M&A. The best companies are bought, not sold. Right?
Exactly.
It's essentially true.
Yeah.
I think, relevance as well. So, you're spending your day or two here. I think make all your conversations relevant. So whether that's on the fundraising side or partnerships and, other things as well, is just coming up to any one of us and just pitching without context and without relevance really is a waste of your time, and doesn't really engender a lot of, we look a lot at what our founders are spending time on and how they choose to prioritize, what they spend their time on. And so I think you, again, build a lot of credibility and validate yourselves when, you're very relevant in your conversation. So I think with all the people you meet here today, and if you are fundraising, find out whether those angels or those family offices or VCs or private equity or whoever it is, which ones of those are really relevant to you. Get to that answer, very, very fast. And again, I think as Martin said, focus on the business, and I think understand your path to growth. I feel like a lot of startups or a lot of people just kind of throw terms at you and numbers at you. And
like AI?
What's that?
Like AI?
Like AI. I mean, like Pleo,
Yeah.
with their finance AI. Like what? So, have a real, again, basis for a path towards that, or a path to that point, and all the kind of milestones you'll need to reach along the way, and that they're ambitious but sensible.
Yes, it certainly helps if it's within the investment mandate. So for EQT Ventures, our investment mandate is between 1 and 75 million euros per investment, with a sweet spot maybe between 5 and 15 million. So if a startup is raising 100K, then maybe it doesn't make sense to have a pitch meeting at that point.
Yeah, I mean, I think the big part is really like do your homework in general. And I did a presentation like several days ago about this. I think the basics actually really matter. So I'm going to go on my monologue of but these are some things that I get all the time, like context, like don't just randomly pitch me. Do your homework on sort of stuff that I look at. So I have gaming companies pitching me. Gaming sucks. I mean, this is my opinion. I think gaming sucks, right? So why would you ever pitch me? Or VR, which I think is total garbage as well, too.
We love gaming in VR, so.
Really?
There you go, right? So exactly.
Yeah, so I think it actually matters of like do the homework on the investor, do the homework on the stage that they're at. Like I have people who are raising Series A pitching me. I'm like, I don't do Series A, right? I'm a seed investor. And that's also a negative signal as well too. That signals that you're an idiot and I would never invest in you. So, it actually matters. And so, final question, are there any sort of like specific areas that you're like really, really interested in over like the rest of this year, and sectors that you go like, man, I really, maybe we haven't done deals in this area, but like I would love to just sort of like find out more and learn more about this area. This is an intellectual sort of like business. What are the areas that you're excited about or you're at least interested in and exploring?
So we are not really top-down type of guys.
Yeah.
You're
hunters.
We're hunters. I mean, and statistically, there are millions of entrepreneurs out there versus 15 investors index. So the likelihood of us coming up with the great idea is quite small compared to some of you guys coming up with great concept that we would never have thought about. Before I saw Revolut, I never thought about it. I was like, yeah, there's TransferWise. Why do I need another app? But it's just different. It's a different product, and they've come up with something unique. Before Menu Next Door, I never thought about that. That could exist. So I think one space where we're seeing interesting things and where we believe there's a lot to do is kind of SME finance and kind of SME banking. It's a huge pain point for everyone. The bank sucks. I mean, you guys, if you're managing a business, you all know that your banks usually do a pretty poor job at managing you and trading you. And when you see what's happening on the consumer side, with products like TransferWise and Revolut and others, and first, none of that is really applied to SME. I think that's we're going to see the same thing that happened in enterprise software, where you start with kind of the consumerization of IT. I think we're going to have the consumerization of SME finance as well. So I think that's really one interesting area that we're looking at right now. But then we just we're just waiting for entrepreneurs to come up with good ideas.
I think health tech again. I think it's a big sector. Lots of pain points there still. Lots of opportunity to introduce digital companies to really disrupt the whole
on the
industry.
Consumer side or B2B side?
Both sides, I think.
Both sides.
But I think, like Martin said, I think it's probably going to start with consumer side, but then hopefully the business side follows a bit quicker than maybe on the banking.
Yeah. I'll add a comment, as I've been doing a lot of digital health in the U.S. It's actually the reverse, because in the U.S. markets, frankly speaking, over-regulated and kind of a mess. And so where we've seen a lot of success has actually been more on the B2B side for digital health and not consumer, because of just the way that the market's structured. So if anyone is interested in the U.S. market, it is a very different market, and it's huge, but it's very, very broken in very different ways. So keep that in mind.
I mean, I think we're in a luxurious position of being able to invest in a lot of pretty much everything we're excited about. I think actually what's been interesting is being here earlier in the week, and even in Vienna with Pioneers, all the kind of material science that startups that are starting to form, and I think we're kind of scratching our heads as to how the hell our model works there, and how do we invest in those kinds of companies. So that's probably one of the more intellectual kind of challenges we're gonna go home and talk about is what we saw this whole week here, and probably next week as well in Finland, is how do we apply our model to two more challenging areas, whether regulated areas or health or materials and such areas. So
Yeah, and I can speak for 500. So we did about 600 deals last year. We're a micro investor, right? The 50 to 100K checks. We'll probably do roughly about the same. And this is one thing we're exploring, where we've traditionally been very, very strong in software. How do you do hardware? We know there's some stuff there. How do you do a lot more like hard technology, like biotech, with not really understanding biotech at all, but it's interesting, and material science and anything in that area we think is, we think there's promise, and we definitely think like all the things that we've seen in software where the cost structures actually come down dramatically, it's happening at the same time in the hardware side, and it's definitely happening on the same side with like the biotech and bioinformatics side, and the reality is that very, very closely tied to health, right? And especially as more people are getting older, there's going to be a lot more money going to this area. But like, if you don't understand it, should you invest or not? We can still do it because it's smaller checks. And so I think we're wrapping up. Thank you so much for this like wonderful conversation, Lars, Reshma, Martin. And I hope you all found this conversation helpful and interesting. And hope you have a good rest of the Friday at the next web.
Okay, thank you. Thanks, man.